Welcome back. We just heard from Rick a little bit about bond yields. Let's dig in on treasuries and the yield curve. Short-term rates have been somewhat stable, but long-term rates rising. What does it mean? And is the market misreading the signs? My next guest says, yeah, that might be the case. Joining us is Todd Gordon, the founder of Inside Edge Capital. Todd, you're trading rates today. Do tell.
Oh, hey, Kelly, happy Friday. No, I always love, positioning the portfolios based on what the macro flow, intermarket relationships are telling us. And, I think the markets perhaps are reading into it incorrectly when you look at the 10-year yield moving up, right? We're breaking up through 4.6 right now. We have some resistance from April, about 4.7. And as Rick said before, what's happening is those long-term rates, 10-year, 30-year yield are moving up, but the short end is anchored as the Fed has maybe a 50-50 chance of cutting once more in May. And a lot of people, I think, on its face are reading it as inflationary, slowdown, protectionist tariffs, reason to sell stocks. But it's getting the yield curve out of inversion, normalizing it on the way up. And I think it's actually leading into some nice rotation into the growth trade.
I see. So you're not trading rates. You're looking at some of these yield curve moves and thinking you want to trade growth stocks?
Absolutely. And I sent a chart along here. If you actually look at, let's overlay, this is kind of weird, Kelly, the 10-year yield. This is the nominal 10-year yield over the value growth ratio. I'm using Vanguard's VUG VTV ratio. And actually, if you look at yields dropping, this is like over the last 20 years, you're going to see a very good correlation of value growth selling off along with yields. The 10-year yield has started to come back, moving up as we've rotated post-COVID into growth stocks. So growth right now continues to outperform. How much higher can that 10-year yield go, feeding that growth value relationship? We shall see. I have a hard time seeing the 10-year yield too much above 5%. I'd like to see the 10-year and 30-year kind of chill out a little bit. And if we can exist with 30, 40 basis points of 10-2 curve sort of normalization, I think the growth trade is going to continue to be able to move in. And what Rick said, really important if you want to get into the minutia of FX. The dollar is moving up, yeah, but it's being led by dollar yen along with the rest of the carry trade, non-dollar carry trade. Global risk guys are putting the carry trade back on. So I'm bullish next year.
And a lot of times, people say they use the carry trade to buy or to chase those growth stocks. So maybe a sign that people are piling into that trade and creating more momentum. Would you, Todd, it's funny because usually when people talk about the yield curve normalizing, they say, and so I like the banks, and it almost makes the case first. And so I like, more traditional areas of value. Are you going to kind of change your strategy if the curve changes, or would you stick with growth stocks next year almost regardless?
No, I think I really think the 4.7, 4.8, 4.9 is fine. And as long as the 2-year yield, which tracks Fed funds, stays at about 4.3, as I said, we'll have 40, 50, maybe 50, 60 basis points. But if we start to get too steep, what's going to happen? Either short-term rates drop too much or long-term rates go up too much. That could be a problem. Kelly, I think the best case to remain bullish on growth in 2025 is hopefully the fixed income market just goes sideways and we don't really have to talk about it anymore, because I feel like post-pandemic, we've all become yield curve and macro experts who invest in the stock market. So I think best case, maybe it goes sideways and we can focus on good fundamentals and stocks that are leading the AI revolution.
All right, Todd, thanks. Appreciate that perspective, that kind of unique take on it. Good to see you today. Todd Gordon.